Greetings, you ever-curious Herle Burly-ites. We're recording the show on Fall Economic Statement Plus one day after Minister Freeland dropped the Fall Economic Statement. So that's precisely what we're going to focus on for most of the pod today. With me to do that, a guest I'm really excited about, not only because it's his first time here on the Herle Burly, but because he's an economist who hasn't been afraid to do some fiscal truth-telling, both federally and provincially, for quite a while now. A very active presence, by the way, on X, if you're still doing that thing. When I was still on the Twitter machine, I enjoyed Trevor's contributions, which are regular and informative and sometimes funny. Trevor Tombe joins us. Trevor's based out west. He's a professor of economics at the University of Calgary, a research fellow at the School of Public Policy. His research focuses mainly on fiscal federalism, macroeconomics, and international trade. He's also a co-director at Finances of the Nation, which assembles public finance data and builds tools to make it more accessible and useful for research and analysis. So here's where we're going with this today. I want to get Trevor's take on the specifics of the fall update. What did we learn and what did it reveal about where we're headed fiscally? I want to talk about that a fair bit. We'll talk about the economy in general, how it's doing, particularly in Alberta and in Saskatchewan, and close with Trevor's analysis on the Canada Pension Plan and where that debate might be going. So, hey, I'm really glad you could join us today. Thanks for doing it.
Great to be here. Thanks for having me on, David.
Now, you may notice I'm wearing a shirt, the band, The Last Waltz. Behind me is The Last Waltz Up. Now, you're a young guy, I can tell.
Yeah,
you're a young guy, I can tell. But I want to tell you that 47 years ago this weekend, the greatest live concert recording and film ever made, filmed by Martin Scorsese, the band gathering all their friends, Neil and Joni and Bob and Van and Eric and Emmylou Harris, the Staple Singers, Muddy Waters. It's absurd. I'm telling you, watch this thing. And as it says at the beginning, play it loud. Anyway, let's get to...
Yeah, I am too young. Not entirely sure what you're referring to, but sounds like it was fun.
I'm telling you, check it out. You'll do worse this weekend than check this thing out. All right. The Fall Economic Statement yesterday. Was it an event?
I think it was an event because of what it didn't contain or didn't actually show was going to transpire. So myself or the Parliamentary Budget Office coming out in advance, anticipating a pretty sizable increase in the deficit. There's a lot of pressures that the government is facing. Oil prices and economic growth challenges here and around the world cutting into revenues. Corporate income tax revenues down significantly from what was previously anticipated. And of course, interest rates. That doesn't just make mortgages more expensive or the borrowing that you and I do. It makes government borrowing more expensive as well. And we've seen the sharpest increase, the most rapid increase in federal interest costs in recorded history, reaching an all-time high in August of $4.3 billion just for that month. And so at that rate, we're looking at close to $50 billion or so in interest costs this year. And then beyond, interest rates may be higher for some time than was previously projected. So lots of these pressures that were going to increase the deficit. And then you add to that commitments to help out in the housing space with funding there, cutting the GST on rental units in particular, or pressure to roll out a pharmacare program, something that would require considerable dollars to be put behind it. So all of these factors were really pointing towards an increase in the deficit this year. And it didn't come to pass. They were projecting a roughly $40 billion deficit. And what did we see yesterday? A $40 billion deficit, basically on the nose. It's a rounding error.
So how did they pull that off?
There was a lot of good luck involved, I got to say. There were many one-time factors that benefited the government. I know that in the last political podcast you had, or I don't know when this is coming out, or a recent one, where you were talking about recoveries of overpayment of COVID income support programs. That right there provided a $5.2 billion lift to the government's bottom line, having higher than anticipated recoveries of some of those overpayments. Also, Canadian consumers have been still spending money to a degree that I think surprises many. And that's leading to higher GST revenues to the federal government. So those are two big things that pop out. And to a lesser extent, the labor market's been really strong. We haven't seen rising unemployment, significantly rising unemployment or weakening in the labor market despite high interest rates. And what does that mean? It means EI premiums are coming in larger than was anticipated previously. So all of these factors basically gave the government enough room to not only offset some of the pressures that they're seeing from higher interest rates and dropping corporate income taxes, but also provide them room to cover some of the spending initiatives that they have in mind. And so basically it was a complete wash this year. But looking ahead, things change. The higher interest rates is not a one-time thing. Some of the economic challenges are still going to be there in 2024. The reduction in GST on rental units, that's pretty big, but it's not kicking in this year. It's really going to start adding to government costs in 2025 of about $1 billion, and then 2026 of nearly $2 billion. So the deficit is widening later. It's just they dodged a fiscal bullet today in terms of what the deficit is for this current year.
Okay, so let's talk about the fisc since you brought us right into it. So let's just stick there for a bit. So as I understand it, the deficit is going to rise over the next couple of years, and so is the debt to GDP ratio. And then the debt to GDP ratio will start to fall toward the end of the 5-year forecast. Paul Martin taught me that 5-year forecasts in budgeting are bullshit, and that everything's always rosy at the 5th year, and nobody pays any attention to year 2. So I don't know what to make. I don't know what to make of all that. But so this is the fiscal track they're laying out for us. To me, it's highly implausible because it assumes that there's no more spending between now and the end of that 5-year forecast, which is inconceivable, really. Point number one. On the other hand, though, Trevor, it is the case. We have the lowest deficit in the G7. We have the lowest debt to GDP ratio in the G7. And since these things are relative, aren't they? We should be fine, aren't we?
Well, let me disagree, I guess, with Paul Martin and yourself here. I think there's a lot of value in these longer term forecasts. That's why we do them. And forget 5 years, the PBO does till the end of the century projections, as does Ontario, as does the United States. And why is this exercise valuable? Well, it's not because we don't think there's not going to be new programs rolled out in the future. The budget, when we get it in the spring, is going to have something new. Of course it will. But what this does reveal is where current policy is pointed, given everything that we think is ahead in terms of interest rates, economic growth rates, inflation being a big one, right? So in order to plan for whatever it is that you're going to roll out later, you need to know where you are now. What does current policy mean for where you might be next year? So these shouldn't be seen necessarily as predictions around exactly where we're going to be in 2028, after all sorts of unforeseeable things occur between now and then. But what they should reveal for us is, what do the choices that we've made up to this point mean for where we're headed? And that's critical because looking ahead, reveals where there might be significant challenges that necessitate changing decisions today. And right now, federally, I think we're in an interesting space where, there's a lot of really good arguments that the federal government has been too expansionary in its fiscal position. I think Sean Spear, someone recently on the pod as well, recently wrote a piece over at the Hub noting that maybe Harper-era tax rates are fundamentally incompatible with Trudeau-era spending. And I think he's really onto something there. And so there is trade-offs of having these deficits projected out, now larger than what were previously planned. But it's not as though we're in a situation where we were in the 1990s, where we needed to act in the way that we did then because 1 out of every $3 paid in federal revenue went towards interest.
Right.
Now it's about 1 in 10. And that does come with trade-offs, spending $50 billion next year on interest costs, soon to be $60 billion. This does mean that we don't have as much room as we otherwise would to expand spending on other priority areas or indeed lower taxes in areas where we think it might be justified. So there's certainly trade-offs from the government's choices and the fiscal track that we're on, but we shouldn't be under the impression that we have a fiscal cliff or a crisis ahead, right? We just have trade-offs at the margin, which is where economists really like to be. But there's certainly no need to press a panic button here. So GDP, debt to GDP, absolutely a relevant indicator of a government's overall sustainability. That can't rise forever. And it is higher this year, we now expect, than it was last year. And they projected yesterday that it will be higher next year than this year. So an increasing debt to GDP ratio, that should raise some concerns, but just some concerns, right? Where they think debt to GDP will be next year is 42.7% of GDP. But where was the debt to GDP ratio, last year? Just under 42. So we're just a 1 percentage point increase in the debt to GDP. That's entirely manageable, even if one disagrees with the government's decisions or would prefer we lower that more quickly. That's a fine debate to have, but we have the luxury of having that debate. We're not in a situation like the US, where the debt to GDP federally is 100% of their GDP. There's a reason why they borrow with a much higher interest rate than Canada, right? They're riskier. We're in a stronger position.
You talked about trade-offs, and I want to go right there because, this large bulk of the debt that has driven up the debt to GDP ratio and driven up these debt servicing costs was incurred during the pandemic. It is not the current year's deficit that is a problem. It is the deficit in 2021 that is the problem, correct?
Yeah, no question about it. We went into COVID with a debt to GDP ratio that was significantly below where we are now, roughly 1/3 of the economy. So there was a sharp ratcheting up in what the overall federal debt was, and it's come down a little bit, but not maybe as rapidly as some might like. Opposition conservatives in particular might point to the slow pace or the ratcheting up, we could say, of their plans from one update to the next. So we're certainly above where we were prior to COVID, and I think that's an important thing to keep in mind. I mean, the government debt is there also as a shock absorber when unforeseen events.
This is where I want to go with you, which is, so right now we're living with the fallout from those decisions, which are that the debt and deficit levels are increasing, are putting upward pressure on interest rates and inflation, and that they are adding to public debt servicing costs. So these are the negative consequences of those decisions.
Yep.
Do you have any counterfactual in your head about what our economic situation would be today had the government been significantly less generous with citizens and business during the pandemic?
So that is something that researchers will be looking at for literally decades to come. People make their careers today still unpacking what happened during the Great Depression. And that is absolutely going to be the case for our experience through COVID. We saw a report from Scotiabank, I think it was last week, if I'm not misremembering, where they tried to estimate, well, what would interest rates be today had federal fiscal responses not been what they were? And they figure they'd, instead of the 5% rate that we have now at the Bank of Canada, it'd be 3%. That's a big drop. But what does that literally mean? It means that income provided to Canadians and to Canadian businesses during the pandemic wouldn't have been there. And so while there might be some macroeconomic benefits from lower inflation and lower interest rates today, there would be costs incurred on individuals and businesses much higher than the world that we're in right now. So the federal fiscal response absolutely comes with trade-offs. Every policy choices comes with costs and benefits. And some of the costs of expanding government spending through the pandemic was some amount of upward pressure on inflation. I think being precise about how much that is really challenging. And I tend to be of the view that it's not that high. And therefore interest rates a little higher than what they would have otherwise have been. But the benefits are felt by individual families and businesses who received that support. And of course, in hindsight, it's really easy to evaluate whether or not a policy response was too big or too small. But I try not to forget where we were in March of 2020.
They had to figure it out in like 3 days.
They did. And the fact that they did and the servers didn't crash and money actually went out was really impressive. But erring on the side of being too generous rather than erring on the side of being not generous enough, given we had no idea how the pandemic was going to unfold, how severe it really was, what it really meant for economic conditions, how long the recession was going to last. Like, we had the sharpest drop in employment in April, March, April, May of that year, the most rapid decline in employment ever, like way in excess of the employment drops, even during the worst point in the Great Depression, right? I think we've forgotten the environment that decisions were being made in. And yeah, we should absolutely learn lessons and look back and better prepare for the next time calamity arrives, as at some point it inevitably will.
Right.
But we should do that with an eye to learning lessons, not placing blame and things like that. So erring on the side of being too generous is where I personally would come down in terms of where the better of the two errors is. But yeah, no question that expanding government spending adds somewhat to inflation, but it does that because it's either itself demanding goods and services, bidding up the price, or giving money to individuals who then go out and demand goods and services, raising prices. Those individuals who received the income transfer are better off, even despite the inflation, than they would have been had that income never been provided in the first place.
Right. What makes David Herle happy? Well, Herle Burly-ites, because you're appreciators of the pod and the sly way I work my personal life into the ads here, you're probably aware of 78% of it. But let me précis a long list for you. Lemon Heart Rum, The Lightest Exercise, Elton, Hawkins Cheesies, Green Riders, and My Dog Rider, Terry, Certain Cannabinoids, Carl Spackler, Jerry Jeff, Prelate, Letterman, Lebowski, and Fresh Data. On behalf of our presenting sponsor, TELUS, I'm going to concentrate on the latter thing today. I'm reporting some fresh data, just released by PwC, about Canadians' appetite for digital data, as well as the overall impact of the telecommunications sector on our economy. I don't often use the word humongous. It just happens to fit here. In 2022, telecoms contributed almost $77 billion in direct GDP and almost 750,000 jobs. As we continue our inexorable march toward digitization, there's potential for more, $112 billion by 2035. And the way we consume data is a little like me with a bowl of Hawkins, difficult to satiate. Lots of figures in the report, but here's one. In the last 4 years, average monthly download traffic has increased by 189.6 gigabytes per internet subscriber. Know what it takes to support supersized growth like that? Supersized investments. I've been talking about it for weeks now. To expand and improve their networks, Canadian telecoms have invested an average of $12.1 billion annually since 2018. Cut another way, that's 18.6% of their average yearly revenue. Higher than what their peer telecoms invest in the United States, Japan, Australia, and Europe. All this is to say, the TELUS just doesn't talk the talk about connecting us. They spend the spend. And they've been doing it since their earliest days as a small Canadian startup. Know what old Carl Spackler would call that? Cinderella story. Okay. Another counterfactual. If if expansive government spending, government deficits are fueling inflation and causing interest rates to be higher than they should be. And we've heard this not just from Pierre Poilievre, we've heard this from the governor of the Bank of Canada. Right? So, if Ms. Freeland had stood up yesterday and said, you know what we're going to do? We're going to cut $20 billion of spending. We're going to do a 1995 budget because we want to get out of the way of the Bank of Canada and get inflation down as quickly as possible. What would the impact of very large cuts to federal spending be right now on the economy?
It would depend entirely on where those cuts occurred. Now, first, just for some relevant context, the Canada, when it's speaking about government spending, it's speaking about all governments, including provinces. If we look at the federal government alone, just its program spending this year compared to last year, it's only 0.8% higher this year than last year. And so that's not itself a growth in federal spending that, to me, is a really material driver of anything around the inflation dynamics that we're seeing now. The big reason why inflation reached as high as it did and why it's fallen as much as it has, including in October, down to 3.1%. This is really an oil price story. And there's not much that a Canadian fiscal policy, federal or provincial, has to do with global oil prices. So we shouldn't overstate the effect of federal spending. Although don't misunderstand me, I'm not saying it's zero. It's just not the principal reason for the ups and downs and the inflation that we have been seeing. So what effect it would have on the broader economy, that would depend. Most of what the federal government does, and I think a lot of people maybe don't appreciate this, is it doesn't really spend money itself. Most of what the federal government does, it is transfers to provinces, who then deliver public services, healthcare, education, and so on, but also to persons. This year alone, $120 billion to individuals. Most of that, elderly benefits, like right there, huge fraction. And I do think, and maybe I'll make a controversial statement here, that elderly benefits grew too much in recent years. And there's a strong case to think about ways of slowing that down, maybe increasing the age of eligibility to old age security. I think of all the demographics.
You may have heard, I don't know if you've heard this, but the last remaining population cohort in which Trudeau and the Liberals lead is women over the age of 54. So I wouldn't be looking for an increase in the age of eligibility if I were you.
Fair enough. Well, interestingly, who does interest rate increases benefit in terms of disposable income? It's not young people who have high levels of debt and low levels of savings. It's older Canadians. And you look at households over the age of 65, their disposable income now after taxes is up, despite price increase, up more than price increases. And a lot of that is because of rising investment income from higher interest rates. So where the federal government should look to, if it does indeed want to restrain further, and I don't think the current government does, but where might Poilievre think about restraint? It's hard to avoid touching transfers to persons and provinces if you're to actually make a real change in the federal government's fiscal trajectory. Like their operating spending, the government itself, including funding to Indigenous and Northern Affairs, to the military, everything is basically only 1/4 of what the federal government does.
Just a quick factoid question. You brought up the provinces. Which level of government is in better fiscal shape right now?
There's a lot of differences across provinces. So I'm speaking from Alberta, and it's hard to picture a better situation fiscally than where Alberta's government is in. And then at the opposite end of the spectrum, I think some of the bigger challenges for provinces would be somewhere like Newfoundland and Labrador, where they certainly have a longer term challenge there demographically, where outmigration is pretty concerning of young people in particular. So they're rapidly aging. So I I do think there's some legitimate sustainability concerns about Newfoundland and Labrador and where it's headed. But provinces as a whole, compared to the federal government, provinces are in pretty good shape. But that's in part because of boosted transfers to the provinces from the federal government.
Right. Just wondering where there's more fiscal firepower if some were needed.
I guess it depends on what we're deploying that firepower for. The federal government's ability to borrow en masse in response to radicalism is just uncomparable to provincial governments. We saw through COVID that there was even some challenges raising funds for provincial governments, partly why Bank of Canada was involving itself in the provincial bond market, something it rarely does. So the Fed's just ability to raise capital and deploy it is far in excess of what we see among provinces.
Okay, so let's move from the fiscal situation more broadly to the economy. Let me put it to you this way. The life or death of this government, relies upon an economy in 2025 that is in clear and obvious to the naked eye recovery. Needs lower interest rates, low inflation, and wind in the sails of the economy in 2025, relatively early in 2025. How likely is that to happen?
A couple things. I think it's very likely that inflation will be back to its target rate for some time prior to 2025. It's almost back to that now. The 3.1% inflation rate we had in October, fully 1 percentage point of that was because of mortgage interest costs. And if these recent trends over the past many months continues, we won't see the bank raise rates further, and we will likely see them start lowering rates potentially in the spring of next year.
Can I just interrupt you? I'm just trying to do the math as you were talking to me. So inflation's 3%. The target rate's 2%. Inflation's 3%.
Yeah.
Interest rates themselves are 1%.
Yeah.
Why wouldn't the bank declare victory and lower the interest rates?
Because that might make prices of other goods and services rise, right? Just because in an accounting sense, the mortgage interest cost is adding 1 percentage point to that total of 3.1. Had we not increased interest rates, the prices of other things would have grown by more, potentially leading to a more than 3.1% overall inflation. So we shouldn't have that mechanical accounting effect.
So they got to keep their foot on the throat a little while longer. How long do they got to keep their foot on the throat?
I actually tend to think that a lot of the pressures are done, and they could and potentially should start to lower rates immediately. I mean, I'm not on the Bank of Canada Governing Council here, so I don't get to see a lot.
Well, I'm voting for you right now.
That's the spirit. I'll take it. I suspect it'll just be a hold at the next meeting because there is some uncertainty here. And the risk of allowing inflation to rise again is greater than having inflation fall below target, right? Tightening too much now is probably where they're going to err deliberately. Because having inflation expectations of individuals and businesses entrenched at a higher rate, that makes it much more difficult to address it later on. And so I think then once we get into the new year, those will be really interesting meetings to watch when they do seriously start to think about dropping that rate. Now, where does the government think interest rates will be next year? This is something we see in the fiscal update, right? It's about 5% of the Bank of Canada now. They anticipate that interest rates, these very short-term rates, will probably drop between 0.5 and 0.75 of a point next year. And then by 2025, potentially getting to 3%, which is what we should see as a neutral interest rate that's consistent with a normal, sustainable level of economic activity. So potentially between now and 25, a full 2-point drop in that Bank of Canada interest rate with inflation back down to a normal level. Yep. That's what the government's anticipating there. Their inflation rate for 2025 is 2.1. right where we'd like. But here's the but that I think is going to be really hard for the government to overcome. Inflation getting back to normal doesn't mean that affordability challenges are addressed. Inflation is about changes. And it's nice that we're not growing any further, but we're not going back to the price levels that prevailed previously. Prices have ratcheted up and are then growing at a normal rate from that higher trajectory. That means living standards have ratcheted down, right? And unless we have productivity growth or other issues that allow wages to grow faster than inflation sustainably, our real income, the purchasing power of income of most Canadians, will be lower in 2025 than it was before, potentially. And that means affordability as an issue is here to stay.
So, November 17th is a great big day for our sponsor, CN. On that date, 28 years ago, the railway underwent a transformation the likes of which had never been seen in Canada. You see, until 1995, CN was a wholly owned creature of government, a crown corporation, carrying all that goes along with that particular status. Suffice it to say, the railway was not a model of business performance. It was inefficient. It required a fair amount of government subsidy to operate. So it wasn't surprising that when then Finance Minister Paul Martin rose in the Commons in 1995 to announce CN's privatization, the reaction on Bay Street was a collective sneer. Who, critics asked, would want to buy such a company? What happened next, though, was surprising, and it certainly wiped away the sneers. A team of managers led by Paul Tellier, the extraordinary government mandarin turned CEO, managed within a matter of months to reform the railway, turning it into a lean, efficient, competitive version of its former self. And when they went on sale November 17th of that year, 83.8 million new CN shares fetched $2.16 billion, the largest and most successful stock offering in Canadian history. Actually, success is an understatement. In the years that followed, CN set the standard for Class 1 railways, modernizing, innovating, and expanding. Eventually, the railway extended its reach to Chicago and south along the Mississippi to the Gulf of Mexico. Today, CN moves Canada's economy smoothly, safely, and punctually. It employs more than 25,000 railroaders, with a market capitalization of more than $100 billion. Its importance to Canadians' way of life is self-evident. Our supply chains would simply clank and wheeze to a halt if CN trains stopped rolling, which they won't. 28 years on, CN bears little resemblance to the entity it once was. Oh, and by the way, a book written about CN's privatization was titled The Pig That Flew. As Churchill might have said, that was some pig. Maybe you just answered the next thing I wanted to ask you about, which is, so the two big problems facing people in the economy are inflation and high interest rates. Inflation has been higher than its target rate, but not high by historic standards of high inflation. And interest rates were shockingly high at 5% after years of zero, but 5%, again, is not a historically high level of interest rates. Lots of other metrics in the economy are going well. You talked about the jobless rate and the relative job security most Canadians should be feeling right now. Freeland had a long list of positive things going on in the economy about foreign direct investment. Blah, blah, blah. When you look at the overall picture of the economy, are you surprised by how sour a mood people are in?
No. And so let me give some other context here. Well, inflation has been as high as 8% before, and interest rates of the bank have not even that long ago have been as high as 5%. The pace of change in inflation that we saw last year, peaking at 8.1%, that acceleration from where we were just 1 year prior, that was the fastest growth in acceleration at any point since the 1950s.
Really?
Right?
Okay.
These are perhaps not as historically high levels, although you do have to go back 4 decades to find comparable inflation rates. even in terms of levels. But you have to go back a lot further before my parents were even born to find as rapid a change. And that means that that's more painful because you don't have enough time to adjust, change behavior, change plans. You're stuck. And dealing with it becomes more difficult for most people and for most businesses. And so that is in part, I think, one factor behind the sour mood that you're referring to, and why various consumer confidence measures too dropped sharply in some places, as low as in the early phases of COVID.
Right. Okay. Hey, you're an expert in the carbon tax, right?
I try to be, yes.
Well, this is going to be fun then, because I've got lots of questions about the carbon tax. How much is it currently contributing to the cost of living? Not the rate of inflation, not what is it contributing to the increase in cost of living, but what does it currently add to the cost of my sliced ham or to my tank of gas in the car?
Well, what it adds to your tank of gas is easy to know because that's an explicit tax that is being levied. I want to say it's about 14 cents a liter. I could be off the top of my head here on that, but roughly that much. What it adds to your natural gas is also something we know explicitly because that's the legislated rate, right, embedded in the regulation that establishes the carbon price. The harder question to answer is, what does it mean for the loaf of bread you buy and the apples and whatnot in the grocery store? Energy is an important input into making most things. And for physical goods, groceries, especially in Canada, where 2/3 of fruits and vegetables is imported now from elsewhere, energy is required to transport those goods from point A to point B. So it's certainly adding. How much depends on the province. And the best estimates we have, tracking all of the supply chain linkages between sectors and how fuel intensive some sectors are compared to others, and that differs by province. Roughly, it's contributing to food price levels now of at most about 1%, just under 1%. So had we not had the carbon tax for all of these years, food prices today would be about 1% lower. And in some provinces, it's even less than that. And so it's certainly increasing prices elsewhere in the economy, but not by an order of magnitude that's relevant given how much food prices have just increased in the past couple of years. Since February 2020, or the first quarter of 2020, food prices are up about 21%. So carbon taxes are not a meaningful contributor to that large of an increase that we've seen, although it is contributing something to the price of food. Most of the costs on you and I from the carbon tax is from our direct fuel usage, gasoline, and home heating. Or I should say now only some home heating.
So the tax is going to be ramping up fairly aggressively according to plans. But you're saying even if it doubled, so then it's 2% of my sliced ham, not 1% of my sliced ham.
That's right.
Okay. So that's not material.
Well, I mean, pros and cons. And it's certainly fair enough for people to disagree with a carbon tax. I mean, one of its merits is that it covers everything, or ideally it covers everything, right? We always have exceptions here and there, and there's interesting debates around that, especially in Canada today. But it covers everything. A ton is a ton is a ton, pays the same amount. And that doesn't allow a government to tailor the distribution of costs. Who bears the burden is something where a carbon tax doesn't really facilitate that kind of nuanced approach. And so while 2% might not seem like a lot, it is an important spending item for many families, and that might be something that does strain some. And then, of course, the rebate is there to help out it's kind of uniform. And so it disproportionately helps lower income individuals cover that additional cost. But yeah, there's winners and losers. And that's part of the political problem here, because the losers might be a group that you might not want to pick as the one that bears the cost of the price increases that the carbon tax leads to.
I bet even the lower half of your Econ 100 class doesn't understand the carbon tax and how it's supposed to work.
I bet you they could successfully draw a graph and convince me that they know what's going on. Whether they do or not is a separate question.
Is it working?
It's too soon to know how much it is working, but there's every reason to believe that it's working because we have this experience in BC where researchers have looked back on and quantified the effect of carbon pricing in that province. It's tough to be precise, and I'll circle back to why, but estimates vary between 5 to 15% lower emissions pre-COVID as a result of the carbon tax existing there. And other countries, Sweden in particular is one that comes to mind that has had researchers look at it in close detail. And so it works in the sense that if something is more expensive, you'll tend to buy less of it, or you'll tend to change behavior to avoid paying the tax. So there's every reason to think behavior will change. There's lots of examples where behavior changes in response to energy prices moving, people opting into more efficient appliances, more efficient vehicles, and so on. Plus, the experience of other jurisdictions suggests that emissions do fall as a result. The problem here, and this is another problem with the carbon tax, is it takes time for us to be able to estimate this. We only know what our emissions are with a pretty considerable lag, and you often need several years of observation to be able to measure what the effect of policy is. And even then, you're measuring it imprecisely, because it's not just the carbon tax that has increased over the past year. There's a million other things going on at the same time affecting emissions. And so teasing out the effect of the tax on emissions is hard. But right. Yes, I reject anyone who says that we know it's not working. I think that's the wrong sense of even using the word working. So that might have sounded really strange. So let me explain this. The benefit of a carbon tax is it makes you, as a decision maker, internalize the cost that your action is imposing on others. And if your action creates benefits for you that exceed those costs, then you're still going to do it. And that's fine. We don't know what the optimal level of emissions is for Canada today, but if you price emissions appropriately to reflect the costs of those emissions, then whatever emissions are is the appropriate level as far as I'm concerned. A cap and trade, though, that's where you pick the level of emissions and you know with certainty where it's going. That's just another way to implement a carbon price. So if someone really wants certainty over emissions, then opt for a cap and trade. The trade-off is that the price is going to vary, and that can create some problems for investors, and therefore potentially a larger drag on economic growth.
Right. But the tax itself, the concept of it, the rebate, the tax itself, implies that I have options and that I'm a rational actor in the face of those options. Let's just start with the options part of it. Are there enough options for people for this to be a reasonable approach?
So this is where I think there's a lot of misconception around the underlying logic of the carbon tax. Most people don't actually need to change behavior or have options. Those individuals who don't have options to change behavior, those are individuals where we actually don't want emissions to fall. Where we want Canada's emissions to fall is in areas where it's really easy to avoid emitting. It's just the government doesn't really know where those are, because we're all making decisions every day. There's tens of millions of Canadians making those decisions and countless more businesses on top of it every day. How is government supposed to know where an easy option is? So we put a price. And if you or I don't actually have options to change behavior, then we won't. And that's fine. These are emissions that you and I are doing that ought to be done from just a pure economic efficiency perspective. We don't have options, so we'll continue emitting. That's okay. And if the government knew in advance perfectly, it had magic, full information that, David Herle doesn't have options, none at all, then exempting you from the carbon tax would be entirely appropriate. And so we do exempt some areas where it's kind of obvious that there's almost nothing that we can do, at least in the short term, such as diesel used in electricity generation in northern remote communities. The trouble is that we don't know who does or doesn't have easy options available. That's why we call it a market-based solution. We put a price on it, and then we let individuals and businesses figure it out. Well, but that's also a political problem, because what if most people don't have options or don't see that their behavior changes?
Well, okay, wait a minute. Let's assume I don't understand this in the fancy way you do. My understanding is I live a block from King Street. So if I don't want to pay the carbon tax, I'll just walk a block and get on the streetcar.
Yep.
And go where I'm going.
That's an easy way to avoid emissions.
Right. If I live in rural Saskatchewan, I'm driving an F-150 everywhere I go.
Yep.
Right? And I have no choice about that.
In the short term.
Right. So I'm just paying more. So, but that's the I don't have an option to replace. Yep. So it's just a tax on me. It is not an incentive for change. It's just a tax.
Yep. Yeah, absolutely. No. It's just a tax in the sense that the benefits to you of continuing your commute are higher than the cost of paying the carbon tax. Therefore, you're not actually a source of emissions reductions that we should want to utilize in the short term. Right? You absolutely pay the tax. This creates equity issues. There's redistribution going on, no question. But you have benefits that exceed the cost of the carbon tax for you, so you optimally choose to keep driving, and that's fine. But maybe your next vehicle is not an F-150. And so what's the time horizon that's relevant here? Well, part of what makes a carbon tax work is not just that it's in place today, but that it's in place for a while and it's ratcheting up in the future. So you're going to be making decisions about your next vehicle that are potentially different. So the number of options that any given individual has over a longer span of time is much greater than day to day today.
Right. Those electric trucks can't haul anything, right? They can't pull anything.
I've seen those videos on Twitter. They're great.
Pulling back from the micro effect of the carbon tax, what has the impact of the federal government's overall climate and energy policies been on the economies of Alberta and Saskatchewan?
That's a great question and a tough one to answer quantitatively, right? So it does depend on what we mean by policies. I think about, what was rolled out yesterday in a way that we've seen some numbers around it. There's still some details left to know. It'd be federal supports for carbon capture, utilization, and storage. That's something that would be a net positive for the economies of Alberta and Saskatchewan, because it's going to be associated with higher investment, higher employment and jobs to build these facilities. And so that's an environmental initiative that's probably a modest boost on growth in Alberta. If I think about the carbon tax, that's something that is a drag on growth everywhere. And it's probably a slightly higher drag on growth in Alberta and Saskatchewan just because we're more emissions intensive. But most of the bigger industries are not covered by the federal carbon tax anyway. That's a provincial pricing system, and there's ways it's trying to mitigate the potential adverse effect economically of that policy. So I'd say carbon pricing, very minimal, because it's not raising money from Alberta and spending it elsewhere, which is maybe we'll talk about that when we get to the pension plan. That's a pretty big issue in the province now. The money stays in the province through rebates, and those are then spent on things from individuals who received it. So modest negative drag there, but other environmental policies that are economically important in a big way haven't happened yet. And I'm thinking about the cap on oil and gas emissions. It's been signaled for quite some time. We have COP coming up. If it was going to be announced, if it's ever going to be announced, it's probably going to be announced at COP. And so a week or two from now, we'll know what they have in mind there. That, depending on how it's designed, could be very significant for the province. Again, depending on how it's designed, it could be done flexibly, right? In a way that's combined with the CCUS subsidies so that they're aligned, so that if we actually build the carbon capture at the scale that even industry is committed to, then the cap might not bind. So that's one scenario, but it could be low and binding without a lot of flexibility. That could have big implications for the amount of oil and gas production in the province, and that could have significant economic implications. So I think a lot of the concern economically in Alberta today around federal environmental policy is around uncertainty about what's to come, rather than any actual policy of the government having big negative implications, with one exception, and that's what was recently found unconstitutional, the Impact Assessment Agency. So to the extent that led to projects that would have otherwise have gone ahead, not doing so, that's a big negative drag on the province there. It's just, I haven't seen any or done any myself, actual concrete analysis to quantify how big that is, but that'd be a real drag.
So we're 8 years into a government that announces its determination to reduce Canadian emissions every single day. And we're 8 years into a government that the governments of Alberta and Saskatchewan have told me is an avowed opponent of the oil and gas sector every single day that they've been in office. And my understanding is that Canadian oil production this year is at an all-time record high. Can you square all these circles for me?
Sometimes in politics, as I think you know better than I, there's many who are prone to exaggeration around what the effect of policy choices have been. I think Alberta's economy has had a really difficult time through 2015 and 2016. Very deep recession with a recovery that was slower than what many hoped for. And just for a sense of scale, for those outside of Alberta, if you look at the peak in 2014 before the recession and the trough in 2016, the total amount of income generated in Alberta shrank 20%, right? That is a huge contraction in economic activity in the province. And it was aligned with a change in the federal government from Harper to Trudeau, like the timing of the recession, which is largely an oil
and
price.
Poor Notley.
Yes,
and Poor Notley.
That's right. And governments, of course, unique to Canada, it's just it's common everywhere, are blamed for bad economic times. And that was a very deep and relatively long-lasting experience. And it is only now, it is only 2022, 2023, where Alberta's economy has returned to a level that's comparable in many metrics to where it was pre-recession. So lots of scarring from that experience. And I think many do blame the federal government, and I think genuinely blame them, but only because that's what many have reinforced where their blame should go. And a lot of political actors in Alberta conveniently do point the finger at the federal government. And that's not unique to Alberta either. Provinces blame the Fed all the time if it's something where they'd rather shift the blame to another order of government. But that's a recession that really was not due to policy choices of any kind. And oil production now is a lot lower than it would have been had the whole price trajectory of global oil prices not fundamentally changed in 2015 and 2016. We would have been investing more and expanding facilities more. So the high level that we're at now doesn't mean that things are not dramatically different compared to where we previously thought they would be.
And how do you think Alberta will fare under the essential phase out of this industry over the next 20, 30 years?
So I don't actually think that we will be phasing it out effectively over the next 20 to 30 years. I look at the Canada Energy Regulator, who regularly produces these pretty nice projections of energy consumption, production across the country in different scenarios. And it has a scenario for the first time this year exploring what would net zero in Canada mean for oil and gas production in Alberta. And at least in that scenario, we're looking at about 3 million barrels per day, which is basically where Alberta was in 2015. Lower than today, but a considerable amount of production will still be occurring for many years to come. And financially for the government, what matters for royalty revenues is production, of course, and prices, yes, but also whether facilities have paid out their initial investments. Once they do, they're kicked into a new royalty regime where payments dramatically increase. And I think there's every reason to think the government of Alberta will be enjoying tens of billions in resource revenues all the way through to 2050 and potentially beyond. The bigger source of uncertainty for Alberta oil and gas production is what happens elsewhere in the world. What are global oil prices going to be? Not whether Canada achieves net zero or not. And I could see it going either way. If you achieve net zero globally, let's say, which I don't think is a likely scenario by 2050, but if we do, and we do it by restricting supply of oil and gas production elsewhere in the world, that might lead to high oil prices. And Alberta would be one of those jurisdictions that would benefit from that in particular, because oil sands production is actually really cheap. It's phenomenally expensive to build these facilities, huge
and high carbon intensive.
Well, if carbon capture and storage does come on the scene on scale as industry itself is committed to, that may not be a concern. And I guess I'll leave it to others to say how realistic that is or not. But the per barrel amount of costs of production here is pretty low. But if we achieve net zero globally because of a drastic drop in demand for fossil fuels, maybe because of technological change, especially in transportation and electricity generation and so on, maybe the price globally is low, and then oil production here falls quite a bit. So there's huge uncertainty out into the future around what production is going to be in Alberta. But net zero for Canada doesn't necessarily mean we're phasing out oil and gas at all. And that's probably partly why Alberta, at least rhetorically, is or agrees with that goal of net zero by 2050.
Interesting. We'll see how convincing they are at COP. But look, can we close on the CPP? Yeah. So, Canada Pension Plan. The Alberta government commissioned a valuation of Alberta's share of the CPP, and it came in at more than 50% of the total value of the CPP assets. You did your own valuation, came in much lower than that, but still, I noted, much higher than Alberta's 11 to 12% share of the actual population. My first question to you is it reasonable to think of this fund as provinces, as being composed of provinces as opposed to composed of individuals? I had never thought of it this way until Alberta raised it, that there was a Alberta share of the CPP or a Saskatchewan share of the CPP. I thought there were just 40 million Canadian shares of the CPP.
Yeah, a couple of things. So first, Quebec is not in the CPP. So Alberta's share of the national population is lower than its share of the CPP relevant population.
Fair enough. Sorry, that's a dumb mistake on my part.
No, that's fine. So the Canada Pension Plan, it's not like most pension plans where you have a certain value in the plan. And if you leave, you can take some with you or transfer it to an RSP or whatnot. The Canada Pension Plan is in part best thought of as just a tax and transfer system. We raise revenues to fund spending on income to retirees. And that income that they receive is a function of how much they earned through most of their working life. It's not them receiving their contributions back in any sense.
Right.
So there aren't individual funds in the CPP. So why is there a discussion at all about how much Alberta is, quote, entitled to if it does leave? Well, when the Canada Pension Plan was first established, it was something where the federal government needed provincial governments to agree. Provinces had jurisdiction in this space originally, not the feds. So we needed to amend the Constitution in 51 and then again in 64 to allow for the CPP to exist in the way that we know it today. And provinces maintained in those amendments their authority in this space, so they could always set up and run their own thing if they ever so chose to do so in the future. And so within the act itself that established the CPP was a formula that says, well, if you want to leave and set up your own thing, first, it has to be comparable. You can't just leave and replace it with nothing. Second, though, if you leave and you set up a comparable plan, then you're going to receive some of the funds in the CPP account. And that was done at the time. It was communicated by the government at the time so that Canadians could be confident in their provincial government's ability to actually make good on the retirement benefits that they're entitled to. So the funds would be provided to the provincial plan in order to make sure that it's sustainable in the same sense as the CPP so that individual benefits could be paid out. The trouble, though, is that they unfortunately didn't put as much thought into the actual words that they were going to put in that section of the act that they, in retrospect, should have. So it basically says there's a couple steps, and some of it's not ambiguous, but one key thing is completely unclear, and that is how do you apportion the investment returns of the CPP Investment Board? And there the act says, well, give to the province that's withdrawing the part of the CPPIB fund, blah, 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 that are derived from contributions. It doesn't say how to do the derivation. And as you can imagine, there's lots of potential ways you could derive returns from contributions. And are we talking about gross contributions, or are we talking about, as some say, LifeWorks, net contributions? Unclear. And so there's different ways you could read that section of the act, different ways of translating the vague words into a mathematical equation. And because we're talking about decades here and the magic of compound interest being what it is, sometimes small changes can accumulate to big numbers over time.
Right.
And my own interpretation, which I absolutely will defend relative to the LifeWorks interpretation, leads to a little over $200 billion less than what they think would go to Alberta. And
what's the difference in interpretation?
So the difference in interpretation is they look at net contributions. So what's contributed to the CPP minus what's paid out as benefits from residents of Alberta, and then take that difference and accumulate it in a hypothetical fund at the same interest rate as what was earned by the CPP. So it's basically putting Alberta today in a position that we might have been in had we never joined CPP in the first place. My interpretation is that the word derived in the act is actually related to our share of contributions, gross contributions, made to the CPP itself. So since the beginning, Alberta has accounted for about 16% of the total contributions made to the plan. Therefore, 16% of the income the fund has generated goes to Alberta. And the reason why I take that interpretation is because that's how the fund used to work prior to 1997. The CPP didn't invest in stocks and bonds and infrastructure and real estate. It invested basically only in provincial bonds. Very boring, very low returns. And it bought provincial bonds in exact proportion to the contribution shares of each province. So a province that accounted historically, prior to 1997, of 16% of total contributions, it would have had 16% of its bonds in the CPP fund, accounting for exactly 16% of CPP income. So I think historic context matters, and the way income was originally derived in the fund was a function exactly set to gross contribution shares. And then you just apply that formula, and I come out with somewhere between 120 and 150, because there is some data ambiguities we don't need to get into, whereas LifeWorks comes out with 330 billion. So huge difference, small, subtle differences in interpretation. It really does speak to the problem here for both Alberta and the federal government. This is not an issue of actuarial calculations or data or anything like that. This is a deeper question of a vaguely worded statute. And we have the feds asking the chief actuary to come up with an estimate around what Alberta might be entitled to. And that's great. They'll be able to resolve some of the data challenges, but that's just a marginal issue. They will not be able to resolve the deeper uncertainty around the statute itself and how to interpret it. So I think if Alberta is serious with this, there's no avoiding a Supreme Court reference case.
I wonder whether they would accept that ruling on it. Is there any way to value, this is probably a really dumb question. You're going to know I'm not an actuary when I ask this question. Is there any way to value, when it comes to a pension, size? So there's two aspects to the CPP. It's not a normal pension, as you said. Part of it's a normal pension, and that's the CPPIB. So that's one of the biggest non-sovereign wealth funds in the world, right? And that, in my understanding, makes it inherently more stable than what something 20% its size would be. Point number one. Point number two is, you talk about terrible downturns in the Alberta economy, like 2015, 2016. They happen from time to time. So with the whole country paying into the CPP versus just Alberta paying in, I mean, if you're an Albertan, how do you value being in something bigger rather than something smaller? Because it seems to me there are clear advantages.
No question. The size of the CPP creates benefits in terms of it having more diversification, if you will. Not only is it bigger as a fund, and that allows it to have in-house expertise in certain niche investment areas, private placements, things like this, that a smaller fund might not, right? And so that might matter for the returns that it can get. Yeah. But that aside, it also covers just a much broader set of geographies with unique economies and unique demographics. And that then pools all of that risk in a way that nationally lowers the risk for everyone. Right. And that's absolutely something you see not just in pensions, but insurance markets. Pooling risks is an important thing that it does. And if Alberta were to go on its own, it would absolutely be exposed to greater standard risks, volatility in investment returns. Yeah, the CPP has to be aware of that, and that matters, but it would matter more for a separate APP, just for a sense of scale. If you kind of model what standard annual variation there is in investment returns projected out over 75 years or so, Alberta only has a 1 in 3 probability, I estimate, a 1 in 3 chance that it could actually sustain an Alberta pension plan at a lower contribution rate than the current CPP. So these are material risks. And then you add to it, other risks like mortality risks, fertility changing. Again, CPP deals with that too, but those risks matter less for the CPP than Alberta. I estimate the mortality risk, the effect of future mortality rate changes on the Alberta contribution rate is double what the effect is of mortality, uncertainty, and risk is for the CPP.
Right, just because of scale.
Exactly.
Right.
And then you add to this an issue that's not related to scale, but if Alberta were alone, then interprovincial migration would matter in a way that it doesn't for the CPP. So that's a new risk. It doesn't matter from CPP's perspective, whether you move from BC to Manitoba or Ontario and so on. But for an Alberta plan, it would very much make a huge difference about whether or not the province continues to be a source of large inflows interprovincially in the future. So no question, the Alberta pension plan comes with risks. I should say there's also little.
Not a word you want to hear associated with your pension.
No, and personally, yeah. But some people like gambling, and maybe they're a little more risk loving, and this still appeals to them. There is a mechanical benefit of Alberta is younger. The average age in the province is 3 years below the rest of the country, and that does lend itself to a lower contribution rate. The government here is suggesting the contribution rate could be a full 4 percentage points lower. And that's based entirely on the implausible asset haul that LifeWorks suggested to them would occur. If we think about a more reasonable interpretation, and of course I'm going to characterize my interpretation as more reasonable, but if we take mine just at face value, then the drop in the contribution rate is maybe only 1.3 percentage points. And that's, how big is that really? Well, for your median worker in Alberta, that's about $27 a month in savings. And so $27 a month in savings, but much greater risk exposure, right? We should, as Albertans, I think the right way to think about this decision of staying in the CPP is that we are purchasing insurance at a not unreasonable rate of just over $1 a day, right? But that's not the conversation we're having in the province. It's very much framed in terms of other grievances around how the federation operates, right. That taps, I guess, a more emotional response among some. So it'll be really interesting to see where it goes from here.
Well, I would think that before Alberta takes out 53%, that the Ontario government would say, well, we want our 65% before you get your 53%.
Yeah, that's another problem with that LifeWorks report. It doesn't take long before all the assets are gone. Alberta plus Ontario is indeed more than 100%.
Trevor, thank you so much for doing this. The knowledge and the wisdom you've imparted today, really helpful. I learned an awful lot from this, so thank you for your time.
My pleasure. It was really great to be here.
Great. I'd like to thank our presenting sponsor, TELUS, and our sponsor, CN Rail. I want to thank all of you Herle Burly-ites who watched or listened to this show this week, and we'll see you next week with more of the Herle Burly. In the meantime, take care of yourselves.
Herle Burly.